Hey guys, welcome back to Stacking Stocks and thanks for joining us today. We're going to discuss why NIO is under $40. Basically, we'll have an extensive analysis of NIO stock. So, what's going on with the giant EV maker? Let's get started. NIO has sold off a lot due to China macro worries related to regulatory crackdowns. This seems to be an overblown risk. However, Chinese politicians want NIO to succeed. NIO offers above average growth at a below average price, combining these positives with a strong brand and an attractive model lineup. NIO could be a solid investment at current prices just above the 52-week low, despite the company's strong execution. NIO has, like many other Chinese companies, sold off a lot in the recent past. Shares have become quite inexpensive, and investors don't have to worry too much about Chinese regulators. We believe that it's in the CCP's interest to let its EV players flourish, which should prevent them from hurting NIO. NIO is well positioned to deliver compelling business growth over the foreseeable future and trades compared to other EV players at an inexpensive valuation. So, why would the government want to hurt the company? Electric vehicle stocks, including the very large ones, are volatile and thus price swings are to be expected. Very recently, however, NIO has experienced a sell off that was well outside of the norm as shares dropped very close to a new 52-week low. So, what's in the pipeline for NIO in terms of trading shares? Shares had been trading around 30% below the 52-week high in early November, but following a steep drop in early December, NIO now trades at just half the share price it traded at in early 2021. This is a pretty steep fall compared to the share price performance seen by other EV players. Now, Tesla, the largest EV company by far in terms of market capitalization, trades at a higher share price compared to early 2021, and stocks such as Lucid Group and Rivian Automotive have also performed way better than NIO in the recent past. Well, that explains why investors are worried about NIO. NIO's underperformance can be explained by a couple of factors. So let's have a look at these factors. Well, what are the underlying factors? For starters, the company felt a relatively large impact from the global semiconductor shortage that we've been experiencing this year, as its monthly sales came in below expectations in some of the summer and fall months. Some other EV players, such as Tesla, have felt a smaller impact from supply chain issues so far this year. However, we think that these issues will be temporary, and as long as product innovation, branding power, and demand remain strong, NIO should be able to grow its business at a rapid pace in the coming years. The fact that sales estimates were missed during some months in 2021 won't matter too much a year from now or a decade from now. Such share price weaknesses that are related to temporary supply chain issues could certainly make for attractive buying opportunities, so there shouldn't be any cause for alarm. An even more important factor for NIO's weak share price performance is related to Chinese macro risks. Chinese tech companies such as Alibaba or Baidu have experienced massive selling pressures this year as investors worry a lot about a range of China-specific risk factors. From what we see, this does primarily hold true for investors from Western countries. Chinese regulators have hurt some industries quite a lot this year, such as online tutoring services, which has resulted in steep and justified drops in stocks such as TAL Education. Chinese regulators also cracked down on some fintech companies such as Alibaba-related Ant Group, although the hit to the business model has been less drastic here compared to what regulators did to tutoring businesses. So far, however, NIO and other Chinese EV players haven't experienced such regulatory crackdowns. Thus, one could say that, at least for now, market worries have not been justified. Chinese politicians have pounced on this opportunity and set a clear goal of dominating this huge future market. This is, of course, only possible if Chinese EV businesses aren't hindered, but aided. Not surprisingly, this is exactly what we're witnessing. Chinese EV players receive aid from the Chinese government in several ways, be it through direct subsidies or rules that hurt foreign competitors such as Tesla. With Chinese government entities and Chinese businesses working on a shared goal, which is China becoming the leader in the emerging EV space, we think that investors don't have to worry about Chinese regulators when it comes to EV investments. Regulation risks seem overblown when it comes to most Chinese tech companies, but even more so when it comes to Chinese EV players. We expect government policies to be a huge positive for Chinese EV players in the coming years, while the market is pricing NIO and other Chinese EV companies as if the government was interested in hindering their growth. It's absolutely in China's interest to foster its EV players, especially those with strong brands and a premium image such as NIO, as those seem to be predestined for international success. It would run counter to China's strategic goals to hurt its promising EV players such as NIO, XPeng, or BYD. As long as the Chinese government remains rational, there's no reason to worry about NIO. Positioned for strong growth but trading at a discount, NIO recently reported its November delivery numbers, which did not look pretty strong. Thanks to a 106% year-over-year increase, NIO was able to deliver 10,900 vehicles during the month for an annualized pace of 130,000 vehicles. Overall, NIO has grown its deliveries by 120% so far this year compared to the same period during the previous year. This makes NIO one of the fastest growing electric vehicle companies, and thanks to average sale price tailwinds, NIO should be able to grow its revenue even more this year. NIO's manufacturing capacity for production handled by Jianghuai Automobile Group was doubled to at least 240,000 vehicles a year through a deal that was announced in May, and its growth plans don't end there. Thanks to the build-out of NIO Park expected to be completed in H2 2022, NIO plans to be able to produce 600,000 vehicles a year at the end of 2022. Note that this doesn't mean that NIO will produce this many vehicles next year, as capacity will be significantly lower in early 2022, and ramping up production to the capacity limit will take some time. For example, this can be seen from Tesla's China trajectory. Still, with the manufacturing capacity of well more than 500,000 vehicles being in place by the end of next year, NIO is positioned for significant growth for many years to come. Sales will be driven by ongoing market growth in NIO's home market, as well as by international expansion. NIO entered Europe this summer, with Norway being the first European country that saw deliveries. NIO has plans to enter all major automobile markets, including the U.S., by 2024, which shows that NIO's expansion to Norway was much more than a test balloon. It was the first step in an aggressive international expansion strategy. With NIO's strong quality and premium brand, the company is well positioned to capture market share in Europe and the U.S., where consumers would possibly be more reluctant to buy entry-level, lower-quality Chinese brands. For NIO, those reservations shouldn't be a major concern. With new model introductions such as the 2022 ET7 sedan, a type of vehicle that should do particularly well in Europe, which has received really strong reviews. NIO continues to look strong from a model lineup perspective thanks to regular new introductions. The lineup is not at risk of becoming stale. Despite its strong growth, NIO is surprisingly cheap for an EV company. NIO stock is valued at 9 times this year's revenue and at just 5 times next year's revenue. Electric vehicle stocks are volatile compared to legacy auto stocks, and they are far from cheap. Some investors thus choose not to invest in the space at all, and that could be a reasonable decision. For those that want to have exposure to the space, stocks that have above average growth, a below average valuation compared to other EV players, and also realistic plans for future business expansions seem to be the best choice. Let us know what you think via the comments section. Don't forget to like, share, and subscribe. Thanks for watching, and we'll see you next time right here on Stacking Stocks.